want to do this, you really want to be avoiding US listed ETFs, how you put your money to work in the investment realm. A lot of Singaporeans do consider their CPF as more of their de facto bond allocation. So a common complaint I hear from investors when they're starting their investing journey is, where do I start? And this is a very complex question because obviously there are many inputs into where an investor should actually start putting their money. Obviously, it comes down to risk appetite, age, investing horizon, all these types of things. But one thing that isn't mentioned a lot is actually the amount of money that you're starting with. So in this video, I'm going to outline what I would invest in with $1,000, how I'd invest with $10,000, and how I would invest with $100,000. Okay, so before I dive into how I would invest the various amounts of money, if you want more content like this, then don't forget to like this video and hit the subscribe button. Okay, so just a few caveats before I dive in. Do remember that this video is meant to be educational and is not meant to be construed as personalized financial advice. Another thing I will mention is that I will be using ETFs as the basis for this video. Okay, so let's start with the $1,000 amount. Now, at this end of the range, you really don't have much to work with. So you really want to be automating your investing and making it the most accessible. So in that sense, I would actually just put $1,000 into one ETF. Now, why is that the case? Well, basically, I don't think you should be trying to convert money or convert your Singapore dollars into either US dollars or any other currency to invest with just 1,000 Singapore dollars. So keeping it in Singapore dollars makes it easy. That means you are confined to really just putting your money into the Singapore market or into an ETF that is listed on the Singapore exchange. And there are a few options here for investors. So as I said, you've only got $1,000. I think dollar cost averaging is the best way to start because actually that instills really good habits in terms of how you put your money to work in the investment realm. So you could start with actually just something super simple like a Straits Times Index ETF. And so there are two big providers of the Straits Times Index ETF in Singapore. There is Spider, which has the Spider Straits Times Index ETF with a ticker ES3. And then there is Amova, which is obviously used to be known as Nikko AM, but it's now Amova. So the Amova Singapore STI ETF, which has the ticker G3B. And the great thing about the Singapore ETF market is you are not confined to having to buy 100 shares of a company like you are with individual stocks on the Singapore Exchange. Do remember that if you buy ETFs listed on the Singapore Exchange, you can actually buy one single share of the ETF. And that's great because the various Straits Times Index ETFs listed on the Singapore Exchange are both cheap. The Spider Straits Times Index ETF is around $4.50 and the Amova STI ETF is at a similar price, around $4.57. So you could actually get started with as little as $5. So how would I do this? I would either put it all into the Straits Times Index ETF in one go, so $1,000 in one go, or I would split it up into maybe 4 or 5 payments, so $250 a month or $200 a month, and you commit to buying the Straits Times Index ETF on the same day every month for 4 or 5 months. In terms of the broker that you can use any of the low-cost brokers. Pretty much everybody has access to the Singapore market, so you can use Interactive Brokers SG, you can use Moomoo, you can use CMC Invest, you can use Longbridge or Tiger. Any of these low-cost brokers will be fine in terms of executing your Singapore exchange trades. Okay, so next up is $10,000, and this is where you can start constructing sort of a core portfolio along with small satellite positions outside. And traditionally in a core portfolio, looking to make up around 70 to 80% of it being in the core, and then sort of maybe 20 to 30% being satellite positions. Okay, so when I'm talking about core, I'm talking about being global in our allocation. So that means buying an ETF that is weighted globally. And if you want to do this, you really want to be avoiding US listed ETFs. So as I repeat, do not buy US listed ETFs due to their tax structure. If you have a US ETF and it pays a dividend, you are going to get taxed 30% dividend withholding tax on that dividend. So say it pays $1 in dividends every quarter, you're actually only going to get 70 cents of that dividend for every dollar that it pays. Okay, so what do we use instead? We use what's called a UCITS ETF, and this stands for Undertakings for Collective Investment in Transferable Securities. And this is pretty much a regulatory framework that has been established by the European Union or the EU and it applies to ETFs that are listed in London and other European exchanges. And the great thing about a UCITS ETF is that it is tax efficient for Singapore based investors and pretty much all non US investors. And why is that the case? Well, basically, the dividend withholding tax on a UCITS ETF is set at 15% since it is domiciled in Ireland and not in the US. So that means for every dollar that an ETF pays in terms of a dividend, you are going to get 85 cents and 15 cents will be taken in tax. So that's pretty much half the tax that a US listed ETF will charge of 30%. One other great thing about UCITS ETFs is that many of them are actually ACC share classes, which means accumulating. So instead of actually paying out a dividend, what they do is they reinvest the dividend paid at that preferential withholding rate back into the ETF so that you can compound your wealth faster. And this is something that is not at all common with US listed ETFs, as US listed ETFs actually tend to pay out dividends as distributions. Okay, so for the core of the $10,000 portfolio, I would put, I'd say, around 70% or $7,000 into just basically a global ETF. And what's one of the best global ETFs out there in the UCITS space? It's what's called the Vanguard FTSE All World UCITS ETF. And this has a ticker of VWRA. And this is listed in London and it is an accumulating share class, which means that the dividends are reinvested so that you can compound your wealth a lot faster. And in terms of its exposure, it's what you would expect, mostly weighted to the US, around 64% in the US, because that is by far the biggest stock market in the world. And then you have countries like Japan, UK, Germany, etc., in second, third, fourth places. In terms of the cost of the ETF itself, it's just 0.19% per annum. So for every $1,000 that you have invested into the ETF, you're paying $1.90 in fees. So it is a very low cost ETF and it gets you very broad exposure to the global stock market. Okay, so then we move on to sort of satellite positions outside of the core. The core is easy, it's simple, it's clean, it's just one ETF. If we move outside of that and think about the satellite positions or things that can complement that core allocation, then I think the STI ETF does a good job, or the Straits Times Index ETF. Now, Singapore actually makes up less than 1% of the value of all stocks globally. But Singapore has many strengths. You know, it has a strong currency, a mature market, reliable companies, and it's the home market as well. So if you do buy the ETF, it's in Singapore dollars. Whereas if you buy UCITS ETFs, they tend to be in US dollars. So for someone who is just starting out and has 10,000, I would be putting 20% or $2,000 into a Straits Times Index ETF. Okay, so we're down to the last 10% or $1,000 of the $10,000 allocation. And I think given the low amount of capital, it's best to be a bit more conservative with this last 10% or so. So I would go for a fixed income allocation to Singapore government bonds. And one of the best ways to get access to Singapore government bonds in the ETF market is through the ABF Singapore Bond Index Fund ETF with the ticker A35. And this is a really low cost way to get access to Singapore government bonds as well as quasi government bonds. So how would you get access to all three of these? Well, for the Singapore listed ETFs, that's pretty basic through a low cost broker. If you're looking at European exchange access, it's a little bit more difficult, but Interactive Brokers and FSM1 do actually offer access to London Stock Exchange as well as other European markets where UCITS ETFs are listed. Okay, and then finally you have the $100,000 bucket. So here you can be a little bit more adventurous or maybe a bit more interesting in the last 30,000 or so. But again, I would put 70,000 or 70% into basically a global ETF. So this could be the FTSE All World UCITS ETF by Vanguard, or it could be the iShares MSCI All Countries World Index UCITS ETF, also known as ACWI. Any one of these works for a global allocation. Okay, so I'd put another $10,000 or 10% into a Singapore listed ETF that tracks the Straits Times Index. So either the AMOVA STI ETF or the Spider Straits Times Index ETF. After that, I'd put actually another 10% or another $10,000 into REITs because this is going to give your portfolio a bit of a different flavor and it's going to give it exposure to real estate. For me, I prefer to get broader Asian exposure with real estate. And there are many good ETFs listed on the Singapore Exchange that do give you exposure to REITs. The one that gives you more Asian exposure or broader exposure outside of Singapore is actually the Amova Straits Trading Asia X Japan REIT ETF, and this has the ticker CFA. Okay, so down to the last 10%, I think we can be a little bit more interesting with the last $10,000 or the last 10%. So I would put 5% or $5,000 into something a bit more growthy, a little bit more niche. And for me, you can always go with China Tech, right? China Tech is high growth. There is a lot of potential there. It has done well, but we all know that China and the US have the biggest tech markets in terms of the biggest tech giants out there. And one of the best ways to get exposure to the China tech market is through the Hang Seng Tech Index. And the best way to get exposure to that is actually through the Singapore listed Lion OCBC Hang Seng Tech Index ETF, which has the ticker HST. Okay, so since there was an allocation to something a bit more high growth and a bit more risky in terms of the Hang Seng Tech ETF, I want to have something else that's going to offset that and balance that risk out. And so you want to think about something a bit more defensive in nature. So for me, I'm going to allocate the remaining 5% or $5,000 to gold. And what is the best way to get access to gold? Well, a lot of people talk about the gold shares ETF or GLD. And they also talk about the gold shares ETF listed on the Singapore Exchange, which is GSD in Singapore dollars. But for me, it's a relatively expensive way to get exposure to gold. So one of the best ways is to actually just buy a London listed ETF, a rather big one, which is done by iShares, and it's the iShares Physical Gold ETC. And this actually has a ticker of IGLN. And this is the US dollar share class. In terms of how it pairs up or compares rather to the GLD ETF, the GLD charges 0.40% per annum in terms of its total expense ratio. And the iShares Physical Gold ETC listed in London charges just 0.12% per annum. So it is much, much cheaper. So there you have it. That's how I would invest $1,000, $10,000, and $100,000. Remember, if I start with $1,000, you really want to keep costs low and just get into the habit of automating your investing and understanding markets. When you level up to $10,000, you can take on a little bit more of a global view in terms of investing, and so really expand into global markets. And then when you get to the $100,000 level, you can start to be a bit more funky in your allocation with your satellite. So in the last sort of 10, 20, 30%, you can allocate to different things. But the one thing that does stay constant is really the core. At the $10,000 level and the $100,000 level, you really want the core of global equities to be there for you. I would add a final note on the fact that these model portfolios that I've just explained are predicated on the assumption that you have at least 20 years or 30 years even in terms of your investment runway and you're not retiring anytime soon, because obviously the majority of it is in equities or more risky assets versus bonds. But a lot of Singaporeans do consider their CPF as more of their de facto bond allocation. So for that reason, that's why I've built these portfolios the way I have. So there you have it. I hope you enjoyed this video. And if you do want more content like this, don't forget to like and hit the subscribe button.